July 12th, 2011. Netflix stock closes at $298. The next day, Reed Hastings announces a 60% price increase. Within 90 days, Netflix loses 800,000 subscribers. The stock crashes to $69, a 77% collapse that erases $12 billion in market value. March 25th, 2026. Netflix just raised prices again. Premium now costs $26.99, a 35% cumulative increase since 2022. Wall Street's consensus: subscribers will pay it. Polymarket prediction markets show Netflix hitting 300 million subscribers by year end. 22 analysts have buy ratings with an average price target of $115. But here's the number no one's talking about. American credit card debt just hit $1.28 trillion, $350 billion higher than the pre-pandemic record. Real wages are flat, and Netflix is betting consumers will absorb a price hike, while 46% of cardholders are carrying balances month to month with no clear repayment plan. This isn't a story about a subscription service raising prices. It's a story about Wall Street mistaking pricing power for brand loyalty. Again, the consensus looks bulletproof on paper. Netflix ended Q4 2025 with 325 million paid memberships, 18% revenue growth to $9.46 billion. The company told investors it's spending $20 billion on content in 2026, up $2 billion from 2025. Wall Street sees this as Apple-level pricing power, a product so embedded in daily life that consumers will pay whatever it costs. The logic sounds reasonable. Netflix maintains over 90% subscriber retention through predictive analytics and personalization. It's not just entertainment, it's infrastructure. You don't cancel infrastructure over $3 a month. Analysts are unanimous. The March 25th price hike, premium up to $26.99, standard with ads now $8.99, will lift average revenue per user 6% year over year. Goldman Sachs published a note calling it sustainable pricing discipline. Morgan Stanley: Netflix has earned the right to charge more. Citi upgraded to buy, citing resilient demand in a maturing market. Prediction markets agree. Polymarket shows 68% probability. Netflix hits 300 million subscribers by December 2026. Options markets are pricing minimal volatility. The put-call ratio suggests traders expect the stock to grind higher, not crash. But there's a problem with this consensus. And it's the same problem that existed in July 2011. Here's the part everyone's missing. Netflix has raised US prices 3 times since 2022. January 2022, January 2025, March 2026. Each time, Wall Street called it pricing power. Each time the stock initially rallied. But here's what the crowd isn't modeling. The consumer balance sheet has fundamentally changed. In Q2 2025, American credit card debt hit $1.28 trillion. That's 66% higher than the pandemic low in Q1 2021. More striking, it's 38% higher than the pre-pandemic record set in Q4 2019. Let's put that in context. In 2011, when Netflix lost 800,000 subscribers after a 60% price hike, household debt-to-income ratios were elevated but falling post-financial crisis. Today, 46% of cardholders carry balances month to month. 23% have no clear repayment plan. Credit card interest rates average 21.5%, the highest in decades. Now overlay the Netflix price increases. Since 2022, the premium plan has gone from $19.99 to $26.99. That's a 35% increase while real wages have been essentially flat. For a family with 2 streaming services, a phone plan, and rising grocery bills, that's not $7 a month. It's the marginal dollar that tips a budget into the red. And this is where it stops being a coincidence. In September 2011, Netflix announced they expected 1 million fewer US subscribers than previously anticipated, a 4% shortfall. Wall Street panicked. The stock dropped 19% in a single day to $169.25. Within weeks, it was at $140. By November, $69. The mechanism was simple. Netflix misread discretionary spending elasticity. They thought they were selling a necessity. They were actually selling entertainment. And entertainment is the first thing households cut when budgets tighten. Fast forward to 2026. Netflix's own guidance for 2026 shows reduced estimates of paid member growth. The exact phrase from their investor letter: not accelerating growth, reduced. That's corporate speak for we're seeing churn we didn't expect. But here's what everyone missed. In January 2022, Netflix raised prices and then reported losing 200,000 subscribers in Q1 2022, their first subscriber loss in a decade. The company blamed the Russia-Ukraine conflict in ceasing Russian operations. Wall Street accepted that explanation. The stock recovered, but Russia accounted for less than 1 million of Netflix's 220 million global subscribers at the time. The math doesn't work. The real driver was price sensitivity in a tightening consumer economy. And Netflix called it geopolitics. Now they've raised prices again. In an economy where consumer debt is 38% higher than pre-pandemic, where nearly half of cardholders can't pay their balances, where the savings rate has collapsed from pandemic highs to near record lows, the trap has a name. Anchoring bias meets narrative capture. Wall Street anchors on Netflix's past success, the company that survived the shift from DVDs to streaming, that crushed Blockbuster, that became a verb. The narrative is so strong that analysts pattern match every price increase to pricing power without testing the underlying assumption. Here's the assumption they're not testing: that Netflix in 2026 occupies the same position in household budgets as Netflix in 2019. It doesn't. In 2019, Netflix was often the only streaming subscription. Today, the average household has 3.8 streaming services. Netflix is competing with Disney+, HBO Max, Hulu, Apple TV+, and YouTube Premium, many of which are cheaper and offer live sports or exclusive franchises. The 2011 playbook is instructive. Netflix believed customers saw them as indispensable. They announced a 60% price increase and a plan to split streaming and DVD into separate services called Quickster. The backlash was volcanic. Their Facebook page flooded with hundreds of thousands of angry comments. Saturday Night Live parodied them. They lost 800,000 subscribers in Q3 2011 and reversed the Quickster decision after 23 days. The cognitive error wasn't arrogance, it was substitution bias. Netflix executives substituted how much value we think we provide for how much discretionary income our customers have left after fixed expenses. Those are not the same number. In this pattern, it's happening right now. Netflix is making the exact same substitution error, assuming brand strength trumps budget constraints. But the data says something different. When consumers hit their debt ceiling, they don't cancel their favorite service. They cancel their fourth favorite service. And in a world with 3.8 streaming subscriptions, Netflix might still be number one, but it's no longer the only one. So here's the real stress test. Netflix is betting that $27 a month is still below the pain threshold for American households. Wall Street is betting Netflix is Apple, a brand so essential that price doesn't matter. But the evidence says this is 2011 all over again. The difference is the crowd isn't pricing it. Polymarket shows 68% odds Netflix grows to 300 million subscribers. Options markets are calm. Analysts are unanimous, which means if Netflix reports unexpected churn in Q2 2026, if that reduced paid member growth guidance turns into another 200,000 subscriber miss, the re-rating will be violent, because the crowd will realize they weren't pricing risk, they were pricing a story. The market isn't a machine for making money. It's a machine for transferring money from people who mistake narrative for numbers to people who read balance sheets and credit card statements. If this is the kind of story you want to see more of, you know what to do.